Welcome to the Cashflow Academy podcast. I'm Andy Tanner, your host. This is where we make investing simple. And I'm here today with Noah Davidson, Corey Halliday. Fun podcast. Corey says we're going to make confessions today of the worst trades we've ever made. And then maybe the best trades we've ever made, see what we can learn. I'm really curious to see what you guys have. But before we get started, make sure you like and subscribe. And drop by yourinvestingclass.com for all things free education and goodies and things like that. With that, Noah, let's start with you. A little brief introduction, please.
Well, I'm surprised you caught me off guard. Like I should have known the introduction was coming, but here we are. I'm a failed comedian, and so therefore I went into stocks, and I found I could get an audience by learning, how to teach people how to trade and invest. And so
failed comedian? That's an understatement.
Yeah, pretty much.
Noah and I are failed comedians.
You've only failed if you stop trying.
That's true, and I never stopped trying.
Oh my gosh, we always say we never guarantee the quality of our humor, only frequent attempts.
That's
Corey,
right.
Introduction.
Yeah, so I've been involved in the markets for the past few decades. I formerly worked as a Series 4 option principal and now do education here at the Cashflow Academy. Absolutely love markets and have a passion for learning and educating.
Fantastic stuff. You guys know me, Andy Tanner, always a student, always learning for 30 plus years now. So I tend to share what I've learned so far as a student. That's the way I like to position that. All right. So since it was your idea to have this confessional,
should we go with worst trades first and then finish with?
Let's go worst and best each guy.
Okay.
So let's start with your worst. Have you ever made a bad trade? I'm surprised. Yeah. What's the worst one?
Well, to set the tone here of worst trade, I put on a trade that literally had 0% chance of success, had only risk involved, and this was when I first started trading. So if you rewind back a few decades, commissions, right? Like now you can buy stock for free, zero commission. Back in our old days, well, it was expensive to buy stock. It was expensive to trade options. I remember that with options, there was like a ticket charge plus the per contract charge. I mean, the expenses were high. And obviously that has changed dramatically where commissions are at all-time lows, zero in some cases for stocks and whatnot. But I put on a trade where I thought, oh, this is brilliant. I'm going to buy the stock and sell this in the money covered call. And I didn't understand even that it was in the money. I just saw that it was a high premium. And so I thought, wow, I'm collecting, I'm spending, and it was small potatoes. It was like spending $1,000 for the stock and getting a few $100 back for the option. But what I didn't understand is that there was really no extrinsic value, time, volatility, and so on. So I bought the stock, sold this option, which only got intrinsic value back. By the time I paid the commissions and additional charges, I literally had no way to be successful. There was not, I had put on a trade where I had lost money the moment I had put it on. Now it wasn't big, but I had lost money and there was no upside. That's about as bad a trade as you can take. And interestingly enough, I think the Federal Reserve has done something similar in recent years where they were still, when interest rates were down at near zero and the Fed funds rate was at 0.25 and they were still buying bonds to drive down interest rates. That was a huge negative. They were getting no upside and they were taking on risks and creating market risks that a lot of firms paid the price for, and that was part of Silicon Valley Bank and so on. So apparently I'm not the only one that can do a stupid thing like that. The Fed did it, but that was many decades ago. Since then, obviously I've learned, and I've had other bad trades. I mean, certainly I've had trades that lost a good deal of money. And one thing that I've learned in terms of risk management, and specifically on the trading side, is you never want to double down, triple down to try to make up for losses. So I've done that same mistake, which is, I'm down $500 in this. Well, if I buy more down here, I'll dollar cost average.
Like
and then
martingale.
And that in trading is a no-no. That's a huge no-no. I've made that mistake. So For anyone that tries that can work on the investing side where you're getting a good asset at a discounted price.
It's fundamentally strong.
Yeah, and you're just wanting, that was your game plan, was to buy more on the way down, but you do not do that as traders. So good trader adage is losers average losers. Don't do it. Don't try to average down on your losers. Not a good thing on the trading side. Now, best trades, I'd have to go.
Hang on, before we go into best trades, I'm going to guess. I think it's Visa, but we'll see. The Illuminati gets in on these early. I think it'd be, from an education standpoint, it'd be wise to talk a little bit about throwing money, because why talk about the bad trade if we don't talk about the lesson?
Yeah.
And so throwing good money after bad
is
a rough deal. And what'll happen in casinos, you talked about this, Noah, is I don't know where the term came from, martingaling. Do you know the history?
There
of
was
that
a
term?
gentleman named
Here we go.
Martingale who came up with the idea
wait.
that if he just had a big enough bankroll, he could go in and play the odds, and eventually he would win. He was correct, except for
table limit.
Table limits is why they invented table limits.
And the very fact that
off it goes.
Sure, you could keep averaging down until you eventually won, but it would be a tiny amount of money.
But it's a really old concept from the 1700s.
You just double down.
Yeah.
You go to the roulette table where it's 48 whatever it is percent, roughly 50, or same with, the casino's only skimming a couple percent on almost every game, whether it's slots or whatever. Yeah. I remember in the old Vegas, they used to say 98% payout.
Yeah.
So if I could $100,
you get 98 back out.
I get 98, $98 back out.
That's
and lose
not good
too.
math.
Yeah, especially when you can cycle through that pretty quickly.
Yeah. So do you remember Lenny Dykstra? Lenny Dykstra was a baseball player back, this is a few decades ago. He played for the Phillies and was kind of famous as this, really gritty player. Well, he got into the financial markets and he started selling some sort of service where, I have this 90 some odd % success rate. And it was all a house of cards that came crashing down on him. But what he was trying to convince, and I don't know, you'd have to read up on old Lenny and whether he got banned from the securities markets and so on. But anyway, what he was selling his subscribers was basically, we buy this deep in the money call, and if it makes money, we take it off for $1 of profit. So you make $100. That was the whole goal. Mm-hmm. But if it doesn't make that $100, we buy more until we make $100, and then we buy more. So he was literally selling.
It'll work until it doesn't. He should have gone the smart route and just bet on games like Pete Rose.
There you go.
Yeah.
Well,
but both of them probably got banned from their industry. The point is that there's a reason that didn't work out for old Lenny Dykstra, and it's not going to work out for you. So just don't average down on those.
It's an interesting. There was a way back when computers were first put into our hands. There was a interesting. It was a gambling thing where you could program strategies, and I thought that'd be interesting to see how martingale would look, because it would graph. And the way the martingale graph looks is it goes up, crash, up, crash, up, crash. It looks like a set of stairs going down. Really, really awesome, and then just devastating.
Because it's very high probability.
Really, high probability. And then that one crushes,
takes it all away, and then
takes everything you got.
Okay, so let's delineate between trades and investments, because I don't have a problem cost averaging
investment
if it's fundamentally
and
sound.
it's fundamentally sound. That's the
well, now you're buying a business.
Right.
You're buying a business.
Yeah, right? And that should be your plan. I would also say that you shouldn't just keep piling more money after bad if that wasn't your plan in the first place. If you say, if it's a good business, great. But I think investing could even get into trouble if people haven't done their homework. They don't know the fundamentals.
If you're buying on price instead
they
of
just
on
think, name the company. Let's say GM. GM went bankrupt, right? Back in and then restructured. So let's just say that somebody just fell back on, well, I've known GM for my entire life, and I'm sure they'll turn it around. And so they just keep buying more and more of a failing business. So you can't just do that with a Lehman Brothers or a Bear Stearns or some sort of collapsing old name. You really have to understand, okay, is this a business that is going to be around long term, and do some of that homework, and then also risk management. Okay, I've got X amount that I'm willing to to put into this stock, but we never go beyond a certain amount, right? That's position sizing. So, Warren Buffett, he's willing to put a lot of his capital into one single stock, but he's done the homework and he knows that company is stable. And if that company ever shows signs that it's not stable, he will pull money out.
He makes the decision irrespective of the price.
Yeah.
And martingales don't.
Yeah.
Right. So martingale, don't put $100 down, or don't put down $1 and lose it, and then put down $2 and then lose it, and then put down $4, $8, $16, $32, $64, $128, $5, $12, all the way up. And because all it takes is that long streak. And that's, to Noah's point, you have a table limit. Well, in your own life, it's your account size.
Your bankroll, and it's called the risk of ruin. And if you keep doubling, eventually,
look how he knows that has names for these things.
I spend way too much time thinking about this stuff.
Yeah. It's called the risk of ruin.
Well, it's what happens when you I have been a degenerate gambler in the markets before. You may or may not believe this, and you probably believe it, but I can show you very quickly how to lose money. It's not hard. It's easy. All you have to do is bet too big and be wrong, and then stay wrong, and then double down. And all so you can reinforce.
Mistakes.
Yeah,
and so, their motive for trading that way is to recover loss.
Right.
Yeah.
It's called loss aversion. It's actually one. So this is really fun. There's a guy named Daniel Kahneman and Amos Tversky. They won the Nobel Prize in economics. They invented the entire new field of behavioral economics, and they wrote this paper called Prospect Theory. And what they discovered about people is that on average, people are risk averse. And they did their psychological testing with simple questions like, would you take a bet? And they would frame a question like this: 50-50 odds, okay, coin toss. You want to bet $100 to make $100? And people would be like, no. But if you change the question from, you are in a coin toss game, you've lost $100 on your first bet, would you like to double down and bet another $100 to see if you can get back to break even? Same proposition, 50-50, but more people would take the same people who wouldn't take the first bet would take the second bet. And I didn't probably explain that exactly how they framed it, but they just changed the framing of the situation. What they discovered is if people are losing, they become risk seekers. Because and so
that's not a good combination.
But when they're winning, they have a diminishing sense of value on the return. So they've drawn this little graph that when you're winning, the sense of feeling good, it feels good at first, but there's a diminishing value of the return. Like it just doesn't, the winning doesn't feel as good as the losing feels bad.
Yeah.
And so because the loss aversion is deeply grained, I think in our survival mechanism, people tend to become risk seekers when faced with a loss.
Yeah, and you'll see this often where people, it's called revenge trading. If I lose on a position, the quickest way I can get feeling better is to make some money back.
Yes.
Especially from the same stock that just took it from me.
I may or may not have done this.
Oh yeah, to make it back in a different stock. Oh no, I got to get it back from
this stock, or I've got to get it back quickly. And so then they start. And it's to that same point. It's a psychological, hey, that loss didn't feel very good. Well, I know how I can get rid of that bad feeling. If I can make back, I just lost $100. I got to make 100 somewhere, somehow, hopefully from the same stock or whatever. But that's revenge trading. Now you're not seeking out the best opportunities. You're forcing what you want on the market. You're saying, I got to get this money back. It just creates a whole handful of problems.
So you say, well, I made a mistake throwing money after bad. Was that a lesson you learned once? Was it over time?
Yeah, I mean, it was a lesson learned, I would say, that I made early on. And then also just through education, realizing that, hey, that's not the way to go. I know you've done the Market Wizards with Jack Schweiger. If you read through those Market Wizards, and I think I've read every one of them, there is one common trait. This guy trades futures. This guy's trade options. This guy trades FX. You know what it all has in common? Risk management. It says, if I lose X amount. If I lose, I try to lose less than what I'd originally set out for. Their whole and sole focus is on keeping losses small. And that keeps you in the game. And you will have some amazing winners in this business. But you have to control the risk side. And it doesn't matter. All of those great traders Paul Tudor Jones and Stanley Druckenmiller. I mean, you look at Stanley Druckenmiller and how good he is at trading. His numbers are astronomical, and his sole focus is, I lose little. I don't care if I lose little. I keep it small. There was an interesting study done. This is a couple of decades ago, and this one also kind of shook me up a little bit in terms of, this was a great study for learning, because it said they went into a brokerage and they said, this pool of people make money and this pool loses. Let's figure out what we can connect between them. And they couldn't find anything. This person used charts, this one doesn't. This one does this, that, And they said, there's only one thing that's connected. The people that win hold their winning position longer than they hold their losing position. And the people that lose hold their loser longer than they hold their winner. That's it. That was all they could connect. And so if your average hold time on a good trade is a month, your average hold time on a bad trade should be less than a month. It should be 2 weeks. It should be 1 week. It should be whatever. That's how you get in the winning side. What most people try to do before they've learned these lessons is they take 2 trades. One of them starts to go in their favor and they go, boy, I'd hate for this to come back and give away I'll hurry and take that profit.
Yeah.
And then this one goes bad and they go, boy, that would really stink to lock in
it's a
this
good
loss.
company.
It'll come back. And so they hold on and
Yeah.
they hold on. And guess what? They held this for 2 weeks. It was good and they made a bit. They hold this one for 2 months. That is a recipe for disaster. So it doesn't matter how long you've been in this business. If you understand that it all boils down to this risk management and keeping your losses small and contained, you will do wonderful in this business.
You remember the poker chip game we played in Houston, right?
Houston at the event.
We set the people up on the table. Everybody had their own little bag of poker chips. The odds were set.
Mike was the best.
And every table blew up except for the one, because Mike knew the lesson.
Well, Mike, if you remember, Mike is begging these guys because he knew. He'd been a long-time student. He understood. He's an engineer by trade. He knew what we were doing emotionally. What Noah was doing to everyone emotionally. And he's like, I beg you, no. Yeah. And they're like, no, man,
we're going to risk it. And he's just sitting there shaking his head. Yeah.
Well, and it was the basic pattern is they'd win a little, lose a little, win a little, lose a little. And the game was totally rigged, mind you. It was completely rigged so that they would have a higher probability of pulling a big loser. But there was more winners in the bag, but they were all small. There was only a handful there's like 4 big winners, and there was like 10 big losers.
Yeah. But as soon as they had a little bit of a downturn, the next person would go bigger. To try to make up. And then they would try to get a little bit bigger to make up for the loss. And it would just compound. And it's such a great lesson, because psychology is a big part of trading. Now, as an investor, there's times where I would say investors get emotional in the bubbles and in the chaos, but most days in the market, an investor's not even paying attention.
Munger and Buffett, as an investor, they say if you can't survive a period where it's 50%, don't even do it. All right, so that's the loser, winner. Yeah. Winner, chicken dinner. Yeah,
some of my very best, you guessed it, have been in the IPO market. You just can't beat if you've been in a big IPO. And the 2 that come to mind are Visa and Google. Those are 2 IPOs that I had a part of, and that made a meaningful
Were you pre-IPO
difference.
with Visa or just?
So I was before it got in. They do an allocation of shares, and I've told this story before, but it's worth repeating. Yeah. So I worked in the financial industry. I was a Series 4 option principal. This is back, I don't know when Visa IPO'd. I should know the date, but I'm going to guess it was 2005, maybe? Something like that. So 20 years ago. And so in the options market,
didn't you just save someone from selling his
time? I helped this guy named Clive, who became a good friend,
he was going to lose
and he wanted to exercise some calls on a healthcare company early, and they still had time value in them, and so he was going to end up wasting thousands of dollars. And so I explained, this got elevated to me. And so I got on the phone with Clive and I took him through the math of it all. And remember, this is a professional investor, but this just goes to show you education is critical. It can be real money. And so I explained to him that a better solution is sell those calls back to the market, get all that time value paid back to you, and then go buy the stock, and you'll be money ahead.
That's rudimentary too.
Yeah, and we worked through the numbers, and he was mind blown that he had never understood that point. And was so thankful. It had obviously saved him and the firm, a substantial amount of money. Well, a few months later, you put in for an allocation, and these big firms, this is how it has always been done, is essentially, if you have money, and you have connections, you get allocations. And for some reason, his firm, so I didn't have access to it specifically, but I wanted in on the Visa IPO. Google was a different story because you could just buy in. That one was a fun one.
$85 a share.
Yeah, that one was a fun one where you could just buy in. But
well, I got a story for you.
Well, Visa, I got an allocation of shares, and it wasn't a big allocation. It was a couple hundred shares, but I mean the returns on that post IPO have been phenomenal. And the only reason I got that allocation of shares was because Clive remembered me and said, we've got more shares than we have people. So I either send them back or I find somebody that would like to participate. And he made a call and said, hey, would you be interested in this? And I said, yes, I would. And so I got in on the Visa IPO. Google was an interesting one because Google, and I wish companies did this, Google, and it cost Google a lot of money, the founders and everything, but they did something that was so great for the general public. Because instead of doing an IPO where the underwriters get this allocation of shares and it's like Goldman Sachs and Morgan Stanley and all of them that have the shares, they did it where it was basically more of kind of an open outcry. Yeah. Hey, everybody has a chance to participate and you could put in for an allocation and so forth. And so that was even before Visa. Now I want to say Google might have been 2002 maybe.
Yeah, something like that.
But that one I just was able to participate. And I wish I had more money. I'd have bought more shares. But
I can pinpoint it because I was sitting on a pile of cash.
Yeah.
And I had opened up my Gmail. I just opened up a Gmail account.
I was sitting on a pile of cash.
And I'm thinking, I really want to get into this Google IPO. But I also needed a new kitchen. So anyway, as I was picking out the cabinets, I thought in hindsight,
that became the most expensive kitchen anyone has ever bought.
100%.
That's pretty good.
Yep.
Yeah.
And it was probably around had to have been 03, 04.
Yeah.
Somewhere in that, but maybe not.
My wife wanted a new kitchen, and I said, honey, I'll buy you 7 kitchens here.
And IPOs are risky, but if it looks like it'll be fairly liquid, buy it, put a stop loss on it.
Yeah. Yeah, I mean, it's an investment. You do your fundamental homework because they'll release release their prior statements, and you can dig into the numbers. The one, and I've said this before, the one that kind of interests me is when Yahoo ends up going public again. Yeah, sometimes
intriguing.
I got into Dell. Dell was that's been one of my best investments as well. Dell did this thing that I didn't like, which is they were public and then they went private.
Yeah.
And so they left. And
same as Panera.
And Yahoo is kind of the same thing. They've gone private, and now the problem is that people hate that. And so, like you went out of the public markets and now you're coming back, and it puts this sort of where people don't want to reinvest in your IPO, but that creates usually a little bit of a bargain. Like I looked at Dell and I said, this looks phenomenal. And so I got in on that, and I really think Yahoo might come back in the market.
Yahoo's interesting
at a decent
because
price.
They have a different niche. Yahoo Finance is a big part of what they do. They're not
Yahoo Sports. And,
they're not trying to compete with Google. They're just a different company than just a search engine now. So, we remember all these IPOs are coming to mind. Remember Uber when we did that in the Mentor Club and all that? Okay, best trade, worst trade. What's your worst one?
One of the things I've noticed over the years is as I talked with traders and myself, we tend to talk about our horror stories far more than we ever talk about the winners. You kind of keep those quiet.
Yeah.
Worst trade. Well, one, the missed opportunities. There's tons of those. Worst, I was pretty new to options. I had started out, kind of cut my teeth with stock, and I avoided options sincerely because the option chain intimidated me. I had looked at all the numbers, and I'm like, that is a lot of numbers. That's a lot of choices, and I was kind of paralyzed by that paradox of choice.
Interesting.
Yeah.
So I avoided options for a long time, and then I finally embraced them after I took a little class on them. I'm like, okay, I understand options now. And I had learned a new strategy. I learned how to put it on. I had no idea how to take it off.
That's a Titanic type
and I can't remember the exact.
That's kind of
You know how to get on the boat, but there's no way to get off as it's sinking.
We got in this boat. There's no life raft.
It's long enough now. I can't remember exactly what year it was, but I can tell you the stock because to this day I've got a vendetta against it.
That revenge trade.
Yeah, the trade was sell at the money puts, take the premium, and buy out of the money calls.
Oh yeah.
So
risk reversal.
Yep. Okay. I put the trade on based off of this beautiful support zone, most perfect technical setup you've ever seen. It just had to win, right?
Just had to. Till Noah gets in.
Well,
Noah's in.
I went large. I sold the puts. I bought the calls, and support broke. Now, to add insult to injury, I'd woken up. I'd spent the night throwing up with the flu, and I woke up that morning just feeling like hell. And I thought I was feeling bad until I logged into my computer, and the support had broken. Boom. And in the course of like an hour or so, the stock had dropped more than my pain threshold could handle, and I panicked.
Oh, man.
And I panicked, and I just shut it down. And I was like, oh. And it was like the quickest.
Rough.
Yeah, it was about $15,000 in 3 hours or something.
Oh my
something
gosh,
stupid like that. And I was like, well, I'm not doing that again.
Yeah.
Oh, my goodness.
You're like, that's a new kitchen.
That's a nice little seminar I put on for myself.
You know what? And it was tuition straight to the market. I learned a little bit about leverage that day. Best trades, probably an Apple post split. Like it was one of their first splits. Again, I can't remember which year, but picked it up right after the split, and the stock rallied hard, and I had a good time with it. So
that might have been like 2013 or somewhere around there. That was kind of
seems
like when they were doing a bunch of splits was in that.
They've done a couple over the last
period,
10 years, 2 decades, but
sure.
it was one of the post splits, and I remember. Well, it had to have been one of the first ones because I picked it up. If memory serves, I picked it up around 45 or something like that.
Yeah,
and rode it hard. But again, hindsight being 2020.
So let's pick apart the mistake. First of all, two things that I picked out, and you'll find when I talk about investing, I'm always saying that it's an exercise in personal development.
Mm-hmm.
And so when you think about that, and if you put a little pie chart together, you say, okay, part of this is educational, part of this is temperament, part of this is consistency, part of this is discipline, and there's all these. So as I'm listening to your stories, the first one was you said, well, I got into a trade. I knew how to get in, but I didn't know how to get out.
I had no idea how to get out.
Never had a plan. And this is the trade adjuster.
Yeah.
So no wonder.
Well, I had
so
to.
No wonder.
That's what I found funny is he was like,
wonder.
oh, there's so many different things on this option chain. And then we always call Noah the king of option adjustments, which is literally using the option chain.
Neo sees the matrix.
Yeah, exactly.
Right? Now he sees
it was probably
and then
part of my stubbornness, and just like that thing whooped me, and
got to get it back.
It wasn't a revenge. It wasn't a revenge trade. It was a revenge investment in time and energy to learn the stuff better.
Yeah.
But then also, not only did you get in without knowing how to get out, but once you got in, it kind of got your face, kind of got punched. That first punch in the face falls through support. You see you're down 8. You see you're down your 10. You see you're down 12. Pretty soon, you just tapped out, not for any intellectual,
purely emotional.
Just so you had an education component to the trade, and you had an emotional component to the trade.
There's an old Mike Tyson saying, everyone has a plan until they get punched in the face.
Yeah.
Well, sometimes people don't even have a plan, and then they get punched in the face. So
that's called pouring salt in the wound.
Didn't see that coming.
Take your cliche. And then your Apple was a good one.
Yeah. And so, and I've learned, hey, a risk reversal can be an actually useful trade if you don't mind owning the stock. And it comes back down to a fundamental asset you want to own. I'll sell the put and let them pay me to buy it. Worst case scenario, I own an asset.
Yeah.
Temperament change, thought process change. So I think experience overall is the best teacher.
Yeah.
Is definitely how I would frame that. And it's everybody, I don't know a trader alive who hasn't gone in and taken a serious loss at some point in time where they're like, you have to learn to respect leverage because the leverage is so tempting, that temptation to get rich quick, that temptation, if I just hit this one, I can insert whatever rationalization you put in there.
There are old traders, there are bold traders, but there are no old bold traders. Yeah.
All right, well, we've run out of time. So I'd love to go in the confessional, but gee, look at the time.
Confess your sins, my son.
So how much time do we have? I've had a bunch early. Really, especially early.
Yep.
When I first started to learn about trading, I came in as a salesman, and I didn't know anything about stocks. They go, yeah, but you could sell our software. Here's the features and benefits. Go.
Yeah.
And so I got really interested in actually doing it. And when you and I built the Ultimate Options course, we started with Greeks.
Yeah.
Well, there's a reason for that.
Yeah. Yep.
We started with Greeks. The idea that you would trade without understanding volatility, time decay, deltas, to me it was wonderful that my first teachers taught me what options were, but it was awful that they taught me in the wrong order. And it was just, everyone back then started with a call option. Oh, look, limited risk, unlimited upside. Boom, off you go. And then the worst thing that happened is I learned spread trading, credit spreads, condors. Everyone that I know that went too fast, they start trading condors. And I was in a credit spread, and I had a bear call on Apple, which, this is before I understood what investing was as opposed to trading. And I had a bear call credit spread on Apple. And it was way out of the money. I mean, it was so far.
No way it could possibly hit that, right?
I mean, come on.
It's impossible. Odds are in my favor.
Yeah, and I had this, it was way out there. And we were supposed to go on a cruise. And back then, there wasn't internet on the boat. And I thought, it's a week, I saw all that. And if I pull it off early, you're going to take a little hit, but if you wait, and so I just risked it.
Yeah. And
I can't remember how much it was, but it was, I don't think it was enough to buy a kitchen.
Yeah.
But it was, at least my position size wasn't horrible.
It was at least enough to buy a few appliances.
I remember, it was really rough, and we got into a port where there was some type of internet we could get when we got into port. And man, it was a hit. And then I can think of two more. I had some mistakes I made on silver a couple times where that bit me a little bit.
Oh, I got caught on when they changed the margin requirements on silver back in 08 or so, 2010, somewhere in there.
Long time ago. Mine might have even been before that.
I got caught by that one too.
Yeah.
And then there was another one that my wife and I were taking one of our first classes, and we were doing it together, and just young and excited, and we're going to be rich, and we just taken I can't remember what the class was, but we taken some seminar on how to, I want to say it was leaps or so, I can't remember what it was, but anyway, my wife was doing some trading, and she hit she went short instead of long or something. It was a pilot error.
Yeah.
Pilot error. Just simply had the trade mapped out.
I've never done that before.
Clicked it, walked away, pilot error. And had we got it right, if we'd been on the right side, it would have been beautiful. But that was, I can't remember how much we lost. It was less than $10,000, but it was, probably 5 or 8 something. I don't remember. But the best part of that story is later on that week, we pulled into the garage, the truck, she pulled in the garage. I was on a business trip or something. And so the little laser beam was clear, but and it was just right. Because when you hit it on, if she had hit it on the bed, it just would have bounced. This is something in his way. It was just enough to where it just kind of scratched all the way down the tailgate, then hit the step bumper, and then back up. My buddy came over to borrow some tools or something. He saw the back of my truck scratched up. He's like, wow, what happened? She goes, Marcy's like, oh, the garage went down. He goes, is Andy freaked out over that? She goes, no, he hasn't seen it yet. He goes, did you tell him about it? No, see when he gets home. And little did he know, I'm like, it's pretty small compared to some of the other.
Yeah.
So if you trade as a couple and you have those losses, you remain bigger than your money.
For sure. Yeah.
And I think the big thing I learned from those is the first one on it was risk was related to control, and I took a risk.
Yeah.
I said, hey, I don't have ability to control this. Let's let it ride. So I gambled. I took a risk. Others, I also had there was always an educational component where I didn't know something.
Yep.
But I'll tell you, the ones that have bothered me the most is when I haven't had consistency or discipline or just took my eye off the ball for a minute. I mean, I've literally had losses, not so much these days, but early on where I just would put something on and didn't check it every day.
Yeah.
And you just check it once. Okay, you're fine. Set your alerts. Nowadays, it's interesting. I have my sons set all my alerts for me and double check them. And so I have an extra fail safe that if if I made a mistake, they would see it. And it also is really good for them in their education, and they do their own trades. So it always comes to them, that personal development, whether it's your temperament or your discipline. Best trades I've made have been in the last 5 years. I went way aggressive in COVID. I put more money in the market during COVID, and some of those great ones, I look at them and I'm like, wow, that's kind of life changing.
Yeah.
Right there. So COVID, and COVID was wonderful because I learned so much from the .com and I learned so much from the subprime. Didn't kind of sat on the sideline in the .com. Didn't have much of a gain or loss. We were kind of still in the learning in the 90s, 25 years ago. And we kind of just sat out, but I just had enough education that the bubble was being talked about, and we sat out. Subprime participated a little bit more, but subprime was hard because it was so Lehman and Bear Stearns, and that one was more emotional than .com. It was faster, I felt. Jim Cramer's freaking out, and that I was a little bit too scared to buy aggressively in the dip.
I did pretty good on the downside during the.
You shorted.
Yeah.
Yeah, but the actual acquiring the assets, I was afraid of where the bottom would be.
I waited too long to buy in the bottom.
I was afraid of where the bottom would be. COVID, I did it much differently. I bought on value. And when I saw a stock, I says, I'm not going to try and time the bottom. That's valuable. I'm picking that up. And I just kept doing more and more and more and more of that. And that COVID was the best. So anything I bought in COVID was incredible. I bought a bunch of Exxon, bought a bunch of Prudential, was just freaking killer. Had a lot of things that doubled, since then. And but it's not so much the doubling of the price. It's the cost basis of the dividend, and now the call rating I get to do. I mean, it's just
and everyone has
cool.
Like personality wise, everyone has their strengths and weaknesses. For me, like Noah and I might be on polar opposite ends, and where he took more risk, I've always had to push myself. Like I'm more risk averse. So it was never a big deal for me in terms of like the nasty losses and trying to be too greedy. That just isn't really part of my personality. But my personality is to basically avoid risk too much. And I have to give Andy credit. I mean, 15 or some odd years ago, Andy would always talk about just, you've got, like, I love shorting the dollar. I love taking on some debt and owning assets. And, and I was always of the opposite mindset. Like when my wife and I first bought our home, it was a small home, I was like trying to pay it off extra. And I was thinking like, I'll just pay this off and I won't have that bill. And really that was the wrong approach, and that I could be putting more money And I credit you a lot because I was able to basically say, yeah, that is the wrong approach. I need to use my good credit and, tap into some of these other ways that I can borrow money very cheaply and own additional assets. And so for me, everyone listening is going to have their personality. They might be more, hey, I've taken way too many risks, or they've been way too conservative and kind of stuffing their money under the mattress. Whatever your personality is, you have to understand what your personality is, what the flaws in that are. And for me, that's being way too conservative. So I'm not throwing caution to the wind, but I do give you a lot of credit in pushing me to kind of say, okay, I need to do less of this and certainly take on more and more risks. And that's just helped me in every aspect of life.
You bring up a good point, because we often talk about risk tolerance.
Yeah.
And risk tolerance is often a bad metric, because what if you tried to run a casino on risk tolerance?
Yeah.
In other words, if I have a personal risk tolerance, that could be way too little,
low.
And it could be way. And I always use that terrible Trekkie, like Captain Kirk would be a horrible investor and trader, because he doesn't think he can lose.
What should we buy now?
Yeah. It's like and Dr. McCoy would be awful, because he'd never make a trade.
Yeah.
He's all like, damn it, Jim, do you need a sedative?
He'd always see too much risk.
Yeah, but if you're going down onto those Klingons, and I'm going with you, and Spock's like, the chances of success are 7,058 million to 1. And Spock would be the perfect guy, because he's not emotional, and he's going to look at that data like a casino would. So when we say, well, you've got a position to your risk tolerance, that could be really bad advice. Now, on the other side of that, everyone's happy. Like I have many things I've done that I lost in. The most money I've lost in my life is starting businesses of my own, especially young, before I even understood trading very much. We'd put so much money into this business, that business, and fail time and again. So I've lost more money in business than anything else, but that's kind of how business is.
Yeah.
But I'll tell you, I would lose that money again simply because I knew it didn't work, and I would have always wondered. And there's an old Mark Twain saying, or Samuel Clemens who has said it, that you'll be more upset about the things and risks you didn't take than any of the things you did do. 20 years from now, whatever the quote is. So I don't regret, you don't
regret the losses that have been from
instructional,
a good probability, risk, reward, all of that. And so
those are not bad
there
trades.
Are mistakes, and then there are losses, and those are two different things, right? A mistake is something that you could have avoided, but you either lack the education or you lack the discipline or whatever. Those could be seen as mistakes. But I have all sorts of, I put on trades that lose money. I'm perfectly fine with that. That's part of the calculation.
And there's certain trades that I haven't made a lot of money on, but they've given me tremendous satisfaction. I'll give you two of those, maybe a third category, most satisfying trades. I was really upset I didn't short Blockbuster, because I was looking at it. I would talk to people about it. That thing's dying, But shorting's so risky. You don't know who's going to come in and buy that brand. Like if Netflix would have bought that brand, then boom, or whatever. So I was nervous to short it. And when they finally went out of, and then GM, I was pissed off, because they're debating, whether to shut it down.
Yeah.
Because and I wrote 401 Chaos. I know why they were shutting it down. It's because of the pensions they couldn't afford. So, I mean, it was like a no-brainer, and I didn't have the guts to do it. So when GameStop started to flounder, I was pretty excited about it. I'm going to short this. So what I did is I bought some long-term puts on it, is how I went bearish on it, and those paid off handsomely. Then like 2 years later was when the fiasco with those. So I could have gotten ripped. I could have but
it was a different calculation.
It was.
You probably wouldn't be shorting it once it was down at like $4 or $5.
And I didn't short it. I bought puts, which is different. Fixed risk. And I'll tell you another fun one. I don't remember if it was you and me or all three of us. But when we saw all the tanks on the border of Ukraine going to invade, we're like, let's sell puts Let's sell puts on the Russian index at $1.
At $1, yeah.
Do you remember that? Did we all three do that?
I did it with
I can't even remember the symbol
all
now.
three of us did. RSX, I think it was.
Yeah.
And so we sold all these.
Yeah.
We said, look, if they exercise them, it's $1.
Yeah.
That's what your stop loss is, bigger than $1 on everything. So I go, we'll sell all these puts at $1
for premiums that were really good.
They were really good, $1 strike. We're like, we got to try this.
But then we were sort of like, okay, well,
what if
it worked out? It worked out. We made money, but then we were like, we sort of felt like
bad.
Maybe we shouldn't be making money off of this
war.
And so then we donated the money.
Yeah, it was awful.
That was funny. Yeah.
But what was funny was all of a sudden when they froze the trading, thinking about the poor guy on the other side of that trade, because he's got to either he's got to exercise or let it go, and they have to kind of had to let it go.
Yeah, you just don't know what the future is. I mean,
that was a pretty funny. You remember that?
Yeah.
When we were
when your risk is one and your reward is infinite, that's pretty good.
See, I looked at it. And
that's like if anyone ever gives
this
you.
Is probably a really bad idea, and I said either one of you two. I says, "Hey Corey, look at this." You're like,
Yeah. If anyone ever gives you $1 million to 1 odds, bet the dollar.
So you're saying there's a chance.
Bet the dollar.
Bet the dollar.
That's kind of what we felt like. Oh, it's a $1 million to 1 reward to risk. We can make $1 million bucks or we can lose $1. That's worth it.
That was pretty funny. Anyway, I'll tell you another fun trade. These just flood with memories. I'll tell you one of the fun trade. Petro Brazil. I always used to call them the Petro Brothers because of the
PBR.
Yeah, the Petro Brothers, but it's Petro Brazil. And I got that one from Robert Kiyosaki, and it was a kind of a cool thing. We were down in Chile, and we were teaching, and Robert brought up that his broker had, what had happened was the corruption in that company. They found a bunch of cahoots with the government and just horrible corruption. Stock collapse. Yep. So Robert went out and bought a bunch of Leaps, and he was kind of excited because he hadn't bought a lot of Leaps, and his broker said, hey, there's these Leaps things. And I said, well, shoot, if you're going to buy the Leaps, why not sell the puts lower? If it drops lower, you can get paid to buy it, right? Instead of buying the Leaps on, the calls, sell the puts. He's like, can you really do that? I says, yeah, you can do that. He says, really? I says, he says, you can get paid to buy this if it goes even further down. I says, 100%. And so we finished the event. We're in San Diego, Chile airport, and he pulls out his phone and he says, here's my broker. Tell him what you told me. So I told his broker, I says, hey, we're thinking about, maybe selling some, puts if it goes lower. Yeah. And he's like, yeah, that makes a lot of sense actually. But what killed me is I remember when I read the book Rich Dad Poor Dad way, 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 way back, and I didn't know Robert or anything like that. And then I thought, wow, you're now
teaching him
like me.
Yeah.
Well, a punk like, I don't know if I've taught him anything, but a punk like me, I never would have thought, if I'd have told Marcy when we finished that book that in a few years I'd be in the San Diego airport trading out of the money put options, showing Robert what I'm doing on it, right? Because I did it in my account right away. Yep. I did it. And it's just interesting what a little education can take a very below average person, and never would have imagined, all those years ago that we'd be the Cash Flow Academy and, you
and
guys.
that's really what the Rich Dad is somebody that knows something you don't. Right, it's like
that might be
you can get education anywhere.
That's a nice finale.
Yeah.
When Marcy and I stopped looking for deals and we started looking for people who could help us, that was probably the biggest turning point in our life of when we actually started to acquire assets.
An investment in knowledge pays the best dividends.
Benjamin
Franklin. There's truth to that. Like, again, the more you know, the more you can grow. The more you learn, the more you can earn. I got all of them.
There you
go.
But
it's true. Education's key.
Warren Buffett's had some amazing investments, and he always says the best investment you can make is in yourself.
Yeah.
Mm-hmm. So, I mean, it's
for him.
For him to say something like that when he's made billions off of other investments.
Yeah.
Pretty
and
amazing.
the mentors in his life, he gives a lot of credit to Graham, but he also gives a lot of credit to Munger because Munger changed how he invested. Benjamin taught him value investing, but Munger took him from trying to get the one more puff out of the cigarette butt. And he says, look, you can only get so big with these tiny little cigarette butt or cigar butts. You've got to have a good company at a fair price, rather than a lousy company at a great price.
Yep.
And that's when he really made the transition to buying Coca-Cola, the big ones that really built who he was. So he could talk about those trades too. Wouldn't that be cool, that Buffett here? Say, what's your worst trade?
Yeah.
The one emotional trade he made that's ironic
is Berkshire. Yeah.
That he was pissed off.
The old textile
They cheated
company.
him out of an eighth or whatever it was. And it really, they didn't cheat him out, but they were trying to, what would you call it, lowball him out of an eighth maybe. And it made him mad, so he bought him and fired him all.
Yeah.
That was kind of a cigarette butt or a cigar butt trade. Now look, it's Berkshire Hathaway.
Yeah. It's funny.
I credit Buffett a lot for, I would not have my buying mentality. The biggest thing Buffett studying him did for me is switch. Like Noah would notice in the Mentor Club is every time something would dip, I'd say, let's buy that. Let's see if it's fundamentally strong. Let's buy that. And to me, tragedy, bear markets, putting stuff on sale. And so when COVID hit, I was like, oh, this is the biggest sale we've ever seen.
Yeah.
I just bought so aggressively.
Well, I studied him in the early 2000s, and it made a huge difference for me just from that
temperament.
Switch. It's that, hey, these are the
switch
assets.
You got to have.
Yeah, you got to own assets to survive, to thrive in life. And also, I love that he always points out the mistakes he makes at every one of his letters. And of course, everyone makes mistakes. A guy makes billions and billions of dollars, and he makes mistakes along the way. And he could tell you all sorts of, hey, here's my worst one. Here's my best one, And he can do the same thing we're doing. We're not anyone that gets involved in this business will have some mistakes, and they'll have some amazing upside. But the point is that when you own assets, it takes care of a lot of the the mistakes don't seem to matter when you've got assets that are appreciating significantly in value.
For sure. Noah, thank you so much for the confessional. Corey, thank you for the confessional. You've been watching and listening to the Cash Flow Academy podcast. Go to yourinvestingclass.com and also subscribe, like, all that good stuff. Hope you enjoyed our conversation. We'll see you next time.